Hello, everyone. Today on the final bar, we'll break down these markets. As we do every Monday, we hit the market from three directions: top-down macro, bottom-up stock picking, and sector rotation. Sort of a choppy, quiet day, which makes sense on the Monday of a busy news week. We've got the Fed meeting Tuesday into Wednesday. We got a lot of earnings, including some big ticket FANG type of names that are going to be reporting earnings. What do the markets look like based on that? Ladies and gentlemen, this is the final bar. Hello, everyone. Happy Monday. It's July 25th, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of stock charts, using data visualization techniques, the best practices of technical analysis, and all the tools we can use to understand market behavior and investor decision-making using the charts. We're going to talk about the overall environment. We spent a lot of time talking about this week. Today was a pretty quiet day, kind of lighter, choppier, which makes sense. And we got a ton of news flow kind of queued up through the remainder of the week. It makes sense today would be a little bit quieter. We're back after a couple of days off. Thursday and Friday, we had some special programming for you. I was in New Hampshire, serving on the board of the Walden School, which is a music school and camp up there. And it's a pleasure to be back with you live and sharing what we're seeing in the markets today. Sort of an interesting move, particularly from energy. And I think when I'm reviewing the charts, which we'll talk about through the course of these three main segments today, you'll see how things like energy have pulled back, starting to bounce higher. Things like consumer staples, which have pulled back, starting to turn higher. Things like technology and consumer discretionary, which have been ramping up, ticking down a little bit. And is that an interesting precursor to what to expect through the course of this week? We'll look at the charts and see what we can determine together. We have great guests on the show. I had a couple really cool conversations last week with Todd Sohn and Jay Soloff, which was a lot of fun. Coming up through the remainder of this week, tomorrow we have Bob Lang from Explosive Options. That's on Tuesday. On Wednesday, the 27th, Dale Pinkert from Forex Analytics. And then on Thursday, the 28th, Mish Schneider, host of Mish's Market Minute on StockCharts TV and a participant in many special events that we run on our channel. So three really good guests to help us navigate sort of this choppy, crazy week with, again, so many potential, news catalysts that can move prices. Let's get on to the market recap. And as I mentioned, right, with a busy week, a lot of times I'm asked, does it make sense to look at charts when all of these things are happening? It's just a news week. I would argue there's no better time because the charts will tell you the sentiment going into the news event. It will tell you a lot about what investors are thinking and feeling after the event. It is a great way to gauge what's going on. So let's look at what happened today. As I mentioned, pretty choppy. At the end of the day, we really didn't go anywhere directionally. If you look at the chart of the Dow, sort of a sideways choppy day, the S&P sideways and choppy, going above and below the zero line. That's the close from last Friday. The end of the day, we traded and ended the day just a little bit above the zero line, right below 4,000. We're currently at 39.67 or so at the close. Same with the Dow, which is up a little bit more. The NASDAQ was actually in the red today. The NASDAQ 100 was down over 0.5%. And as I mentioned, sort of one of the side stories today, really, I mean, the story, I think, if there was one today, was strength in things like energy and utilities, weakness in the FANG sectors. Now, what's interesting is we're setting up for some significant earnings this week from some of the largest names. We've got Amazon, Apple, both on Thursday. We have, Meta on Wednesday, Alphabet, Microsoft tomorrow on Tuesday. So a lot happening. And again, a lot of potential catalysts to move the needle. But so far going into that string of announcements, it's sort of cyclicals and defensives over FANG. So an interesting sort of narrative going into all of those earnings. And obviously the Fed meeting Tuesday and Wednesday as well. Mid caps and small caps both outperform the S&P, up about 2/3% each. Looking at interest rates push a little bit higher today, and that's certainly in general going to help value stocks over growth stocks. Higher rates don't tend to be great environment for growth stocks. That's been much of the story of 2022. And today, in one small slice of that year, we're seeing a bit of that as well. Bond prices obviously down if interest rates are higher, and the dollar index not too much off of where we were end of day on Friday. Looking at commodities, a lot of green, except for precious metals. So you have gold and silver down a bit. Newmont Mining reported earnings before the open today. Ugly chart that really continued to push downwards. I think by the end of the day, it was about 13% down from Friday. And we've talked about the ongoing weakness in gold, why the strength in the dollar has made that just not a great place. And mining stocks have been struggling. We'll dig into that a little bit when we get to our segment called Shifting Stocks a little later in today's show. We'll look at Newmont and along with many others as well. But strength in the rest of the commodity space. And as I mentioned, energy stocks doing just fine today. Cryptocurrencies all in the red. These are the 10 sort of most liquid coins that we track on the StockCharts platform. Starting at the top, Bitcoin and Ether, really the two significant ones that we tend to refer to pretty regularly, both down in a pretty big way here. Bitcoin's still remaining above 22,000, although that's just after a bounce higher before we go live here. Much of the day was spent below 22,000. And we've talked about that potential rotation. You've seen a nice bounce from a lot of the crypto space, but through the course of the weekend, now rolling back over here into Monday. Ether down to around 15, we'll call it, down about 5% from where we were yesterday. Yesterday finished around 1,600. So further weakness in that in those very liquid cryptocurrencies. Let's look at a chart of the S&P 500. We'll go elsewhere as well just to tell the story of the big picture movement. So when you're looking at a chart of the S&P 500, we traded up on Thursday of last week right to 4,000. I've mentioned many times on the show the importance of big round numbers. It seems kind of like a silly thing. Like, why would that matter if the S&P is at 4,000 or not? I will tell you, it matters because humans are trading and they look at price levels. And when a major anything gets to a different first digit, people pay special attention to that because all of a sudden it's something real, right? Going from 4052 to 4051 is not a big deal, but going to 4,000 to 3,999 all of a sudden changes. And it's like, whoa, hold on a second. Are we below 4,000? That's time to revisit it. And a lot of times as a result, people cluster orders and cluster trades around key levels like that. That's often a trigger. So I'm not surprised that on Thursday, we closed right at 4,000. On Friday of last week, we actually opened right around there and then ended up closing back below it. Today, again, no real change from where we saw on Friday's close. So we're below 4,000. That would be sort of that key level of resistance I'd be paying attention to through the course of this week. Obviously, the week finishes above 4,000. That's pretty impressive given the fact that you have the Fed most likely raising rates, which is going to put further pressure on growth stocks, I would argue. And also you have all earnings, right? So you have all these, key growth names, these mega cap names, these FANG stocks, along with others like Qualcomm and many others, Roku and Intel as well. You've got a lot of potential catalysts for these stocks to bounce higher. Also, a lot of potential for a catalyst for these stocks to rotate lower. If you start to see negativity about not this quarter, but looking forward, that's been challenging for earnings here recently. And this is a really key week to try to make that assessment. Beyond there, it's all about where we're at right now. Look to the left and see previous levels. So now that we're sort of in the wilderness here in the middle, you've got 4150, 4175. That's resistance from June and based off of a Fibonacci level as well. On the downside, you're really looking at the all-time, or not the all-time lows, the 2022 lows around 3650. We're sort of right in the middle of that range. Let's see which way the market fluctuates around those levels. One other thing I wanted to mention to you, and then we'll finish off or continue on to our next segment. When you have this sort of noise, you have this sort of volatility, it's always important to sort of take a step back and see where we're at relative to key levels. And the Dow theory, which is looking at major averages and how they relate, is often a good way to try to make that assessment. When I'm looking at Dow Industrials and Dow Transports, we'll spend just a moment on this. They both made a new low for the year in June and have not so far in July made a new low for the year. July is done at the end of this week, essentially. And so you've got a couple more days to make a new low, but this could potentially be the first month in 2022 where you're not really getting that follow through with at least one of those making a new low. Now, I tend to be way more interested in the new Dow theory, which is looking at the S&P 500 and the NASDAQ composite. Are they confirming each other or not? It's worth noting, again, both of these made a new low in June. Both of those have not, or neither of them have made a new low in July, but they've traded higher. Now, all eyes on the early June highs. That means around 4150 on the S&P. That means around 12,300, we'll call it, on the NASDAQ composite. They both rallied, but neither of them have regained their June low. So my question on this chart, which comes first? Do we eclipse the June high? That's a pretty bullish development this week. Do we trade back down and make a new low for the year, get below those June lows? That would be a signal of a continued, maybe new leg lower for the major market averages. Let's continue on today's show. We talked about the big picture and, again, short-term strength, but overall, a lot of challenges left on the charts of the major averages. Let's get to our next segment called Sector Setups. What we like to do is start with the RRG. This is the relative rotation graph that Julius DeKempener, one of our StockCharts contributors, developed years and years ago. I've followed Julius and his work for a long time, and I'm a huge fan of how it allows you to visually represent the rotation that many of us have been talking about and working with for years and years. Obviously, well before Julius and I were involved in the markets, they were talking about business cycles and economic cycles, how the market tends to have this natural rotation of different thematic plays in the equity markets. The RRG just visually represents that so beautifully. We start with the weekly RRG, and it's worth noting that the three FANG sectors are the only three that are really in a constructive trend in that they're in the improving quadrant. And up until today, or up until the last couple of days, have been rotating more positively. So technologies heading northeast, consumer discretionary northeast, communication services actually rotating back due south. That's a challenge, obviously, right now, because strength means we're in the improving quadrant. We head northeast, we go into the leading quadrant. This is when real outperformance tends to persist. And when you have these nice long stretches of outperformance, that would be a real change of character if you had the FANG sectors in the leading quadrant and all these other cyclical sectors in the lagging quadrant. We're not there yet, and you're starting to see some bit of a sign of weakness there with communication services rotating lower. You are not seeing any change in the longer term trend away from energy, away from utilities, away from consumer staples, particularly from materials, all rotating southwest. All of those, by the way, are in the weakening quadrant. So overall, we saw energy be a strong outperformer, clearly the outlier in the leading quadrant, now rotating down into the weakening quadrant. All of these sectors now in the weakening quadrant, and the improving quadrant is full of the FANG sectors. That is what the market has been telling us over the last month or so. That's why these, using the weekly data, have all sort of evolved this way. What I would be looking for on here, the bear case would look like this. These weakening sectors would start to improve. Ideally, make a rotation to the right of the y-axis and start to head northeast again. If any of these start to hook up to the northeast, that tells you there's a renewed strength there. Real estate starting to do that over the last week or two. It would also involve these growth sectors, I think, rotating down back toward the lagging quadrant, which is why this drop that we're seeing in communication services may be a sense that may be beginning to occur, where you get this sort of relative weakness emerging with the other sectors. You're not seeing that yet with consumer discretionary or technology, which are the other two, which so far are holding up okay. Let's look now at the sectors using the candle glance functions. So you can look at all of these charts sort of all on the screen at once. It's a really beautiful way to just compare patterns, to identify outliers, and really see some of the larger themes that are playing out, which you can only tell when you really look at all these charts at the same time. Start to, compare between these different patterns. Now, what jumps out at you as you're looking at these charts? So what I like to do is start with the price relative to the moving averages. Which of these sectors are in an uptrend, meaning you're heading northeast with and you're above two upward sloping moving averages. The problem right now for the markets is absolutely none of the 11 sectors actually fit that description. None of them are in a classic uptrend as defined as I just described to you. The last we saw that was back in June, when energy was making new highs for the year and was above two upward sloping moving averages. There's been such a pullback down to the 200-day for the XLE. It's starting to change. But let's look at energy for a second, because I think it's actually kind of a compelling example here. Look at how energy coming off of the new high in June, swinging back. And obviously that was quite a pullback, blowing through the 50-day moving average. This is as the growth stocks really starting to work. Energy, which had been by far the outperformer in terms of performance, pulls back. But look at what's happening here. Bouncing off of the 200-day, now making a bit of a new swing high. And you see that not just with the XLE, the sector ETF, you're also seeing that with some of the individual stocks. names like Diamondback Energy, like Devon Energy, and even others, PXD, Valero, like a lot of them kind of look pretty similar to that. And I don't mean to jump too much into our next segment. You see how DVN, right, pulling back to its 200-day, potentially getting a bit of a bounce off of that support level. A lot to be proven before energy looks good again. So let me be clear on that, right? I think with the XLE, getting above the 50-day, getting above the swing high from June would be key, which means you have to get up to around 77 or so, 78 to get above those levels. So there needs to be a little bit more upside to really confirm that. The RSI is just above 50, so you need to see that push higher as well. But you're starting to see a potential narrative where the energy sector topped out, pulled back right around 38.2% of the way. Look at how well that mapped right to that first level. That's also the 200-day moving average bouncing higher a little bit. That is a theme to watch through the course of the week. Exxon and Chevron, by the way, both reporting on Friday. That's after Valero reporting on Thursday as well. Some other energy companies reporting this week as well. So earnings are certainly going to be a big part of the discussion today. Just to finish off here, talking about sectors, what's the opposite? What is in a classic downtrend below 2 downward sloping moving averages? Not many. Actually, materials is the only one, given the bounce that you've seen over the last couple of weeks. Only materials, the XLB is the only one that's below 2 downward sloping moving averages. The rest of them are sort of in what I call the wilderness, right? They're sort of in the middle. They might have regained their 50-day, like technology or real estate. They might have started to get above their 200-day or started to find support there, like utilities. But overall, very few of them, communication services, also along the lines with materials in a classic downtrend. But the rest of them sort of recovering a little bit. Just before we go to the break, I want to highlight financials as an interesting one for sure. Now, interest rates most likely raised significantly, at least the Fed raising the short-term end of the curve. The long-term interest rate picture has been sort of choppy, right? Big rise, but now giving back a lot of those previous gains. The yield curve is inverted, which does not tend to be a good environment for financials, but a lot of them have bounced a little bit. When we come back from the break, we'll talk about some of the financial stocks because you're seeing, similar to consumer discretionary, short-term strength, but into resistance and a high potential that those stocks tend to fail here. Let's take a quick commercial break. We'll be back digging into some of those individual stocks that are making up these larger themes. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down these markets from a technical perspective using the power of StockCharts. A couple quick announcements before we get to my next segment, Shifting Stocks. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show on Tuesday. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We're going to gather all those questions. We'll have to answer one of yours live on the air on Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. All of our great interviews, my discussions last week, and from previous weeks as well, along with all of our special events. Martin Pring just came out with a mid-year market outlook, which we published last week. We have our latest episode of The Pitch coming up very shortly. Our mid-year market outlook coming up soon as well. All of that and much, much more on demand at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on with our next segment, Shifting Stocks. This completes our three-pronged approach to market analysis on a Monday. Big picture, talking about the rally in stocks potentially starting to fizzle out a bit. We talk about the sector rotation, how energy potentially rolling up higher, some of the weakness that we've seen in some of those other sectors as well. And now let's get to some individual names. We'll start with Newmont Mining. Now, I don't talk a lot about gold stocks recently because the picture for gold has been so negative, and we've covered that. We've talked about how stronger dollar means weaker gold, generally speaking. It's just not a great environment for gold to thrive. And mining stocks, which had been doing pretty well in the first quarter, Newmont, others, I'm trying to think like R Gold, RGLD, Gold, GOLD ticker, that one, other ones as well, all doing well in the first quarter, but really rolling over as the strength in the dollar overwhelmed any potential for gold prices to recover. And Newmont just reported earnings before the open today. I haven't had a chance to review that earnings report and what happened, but the chart of the price tells me enough that was not a great report, did not go well. And as a result, Newmont decisively going to a new 12-month low. Again, could this be the bottom today? It could, but I have learned to never confuse the bottom of the page with support. Prices go down for a reason. I would much rather wait for the price to show signs of stability, show signs of accumulation, show signs that investors are stepping in. This tells you investors are still parting with the stock and finding other opportunities elsewhere. Let's wait for signs of strength before we get excited about a chart like that. Now, where else should we be focused? A lot of things we could talk about. Apple's obviously a pretty important name. We're going to talk through much of this week. We'll be covering all the different narratives with the different FANG stocks. Many of them reporting earnings Tuesday, Wednesday, Thursday, most after the close, if I remember right. Looking at the list earlier today, Apple's an important one. And when we talked about Apple, sort of the larger structure of the chart of Apple, if you take the low from March of 2020, you take the high from January of 2022, we then sort of pulled back and we had a lot of support right around 150. And that's interesting because that's where resistance was in the second half of 2021. Finally getting above 150 was a real sign of strength there. Now, all of a sudden, we're testing that support level, that resistance level from above. It's become a support level. Look how many times we've tested that shaded area. When we broke below there in May, that was a key part of the bearish thesis for stocks in general. And now Apple's been bumping up against that level. We just barely dipped above there. And by the way, we bounced off of Fibonacci support in June as well, which is noteworthy. But now all of a sudden we're testing short-term resistance. 150 is a key level because that was resistance in June. That was the most recent swing high. So as we talked about last week, stocks like Apple getting above their swing high from June, that's key, right? And the more and more that happens, the more and more the market looks like it's in a broader recovery. Here's the risk, though. What if Apple doesn't stay above 150? I would argue the bullish case for Apple, and largely speaking, the bullish case for stocks, is you break out above resistance and you hold it, which is why when a stock breaks above there, I think you think of a stop at that breakout level, because as long as you hold that, the pattern stays in play. If we start breaking below 150, all of a sudden there's a risk that we go back and retest the lows. There's a risk that was a false breakout. That was sort of the last move higher, and all of a sudden we rotate lower. So 150 is a really important level. That's why this stock you may want to have this on a watch list, have this in a chart list of key names to pay attention to see if that level of resistance, now support, is able to hold. I'm curious whether or not that's going to happen. Now, one of the reasons why I'm curious is because a lot of the FANG stocks have a similar kind of thing, right? Where they've rallied, they either just broke out last week or they're facing resistance. Look at the chart of Amazon, the high from June, which is around 125. This is called a shooting star pattern, which is where you have an uptrend, you have an open, you trade a lot higher, but you close back more the lows of the day. It's sort of like if it has happened at the lows, it would be called an inverted hammer. When it happens after a run higher, you call it a shooting star pattern, which is basically a run higher, you open, you trade higher, you close back at the lows. That's a short-term reversal signal, and it happened right around where we ended the week last week, or really where we ended Thursday of last week. 125. We came up to that level almost right to the tick on Thursday. We closed there on Friday back lower, and today following lower as well. Again, the bullish case for stocks, if you buy into this idea that this is not just a fluke bear market rally, but something bigger, stocks like Amazon will have to regain, not just approach resistance, but power through them. We're not seeing that yet. We're seeing the stock actually pull back from resistance. So as we're going through this week, as we lead up to their earnings release on Thursday, that's what I'd be looking at. Can Amazon regain 125 or get above that level and hold it? So far, it's not necessarily happening. I mentioned in the energy space, charts like Devon Energy, DVN, Oxy, Valero. These are all stocks that have a similar pattern to the chart of DVN. These are stocks that all made new highs, for many of them new all-time highs in the last about 6 weeks ago, 2 months ago. Then we pulled back, right? And the energy sector went from being up 60, 70% to being up 20, 30, 40-ish percent. I forget the exact number as I'm have the charts playing through in my mind, but pulling back quite a bit, right? So for something like DVN coming down from, almost 80 to about 50. So that's quite a haircut on a stock that's had a pretty good run. Now you're starting to see a bounce higher, right? You're starting to see a bit of a rotation higher. Now, again, it may be early days to declare this a huge bottoming pattern. I do think that there is further upside to be had in the commodity space. I don't think we're done with inflationary pressures. And if that's the case, then you most likely see DVN and Oxy and VLO start to recover from here, start to rotate higher. With Valero, it's a really interesting one because it's right at $100 a share. And I love when a big round number comes into play. That's where the stock has bounced off for the last month or so. Holding 100 would be pretty key. Bouncing off of there and rotating higher would be interesting. It's not happened yet. So far, it's just not going down anymore. And you have to see if those stocks rotate higher. I want to talk a little bit briefly about consumer discretionary versus consumer staples, because when I'm looking for names, I'm finding things like CZR, some of the gaming stocks. This is what a lot of the consumer discretionary names look like. Obviously, a clearly established downtrend over the last 6 months, really, we'll call it year to date. So we made a new low in January and then just continued to push lower. We've bounced higher to the 50-day moving average, which not surprisingly has served as resistance so far. So right around 45 was the swing high in June. And similar to Amazon, we've now traded up to resistance, but we haven't broken above it. So far, bouncing off of the 50-day moving average. You see those other gambling stocks with a very similar pattern. So it almost feels like the longer-term trend is down. You've had a short-term bounce, but not enough to really trigger any buy signal, right? Trigger any sort of validation of that downtrend. Now, this is interesting because some of these names have had a bullish momentum divergence, lower lows June into July, higher lows in momentum, which is why this is kind of an interesting chart to watch. See which way this breaks. Does the bullish divergence pay out, which means we have to power above the 50-day and power above 45? Or is this just the latest bounce among many bear market bounces before the next leg lower? And I think that's why it's an important chart to watch this week and really in the coming weeks. Now, compare what you saw there and also things like McDonald's and bouncing up to resistance around 255. You have home builders that have bounced up to resistance as well. A lot of the consumer discretionary names look like that. Compare that to consumer staples. Look up charts like GIS, like TAP, like Kellogg. They almost look the opposite, start to rotate back higher after a pullback. Some interesting patterns in consumer, but we need to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell this story of this market environment. Here's chart number 1. I talked about consumer discretionary, some of the pullbacks or rallies in some of the gambling stocks, but potentially fizzling out at resistance. Some of the nice rotations higher in charts like TAP, General Mills, and others. That all feeds into this ratio of offense versus defense in consumer. At the bottom, it's the equal weighted version of consumer discretionary over consumer staples. When this is trending lower, the defensive side of the coin, consumer staples, has been outperforming, which means overall the market is in a distribution phase. We're really in more of a defensively minded phase. You see how that ratio peaked in November, and from there, we've been in a pretty clear downtrend. We need to get above the highs from June to trigger any sort of reversal. We could confirm the downtrend by getting to new lows, which we last saw at the end of June. Now, the cap-weighted version did briefly tap above there on Thursday of last week before breaking back down. The equal-weighted version is the one I would certainly be watching. Chart number 2 is General Mills. I mentioned some of the consumer staple stocks that have done so well. Look at the chart of GIS. Resistance in April and May around 73, pulling back to the 200-day, now breaking above that level of 73, now pulling back and potentially bouncing off of there. Stock up today when the markets were flat. This is what a lot of the staple stocks start to look like. They're actually showing pullbacks within longer-term uptrends. Those in general tend to be the types of names I would be much more interested in. General Mills, I almost said Goldman Sachs, wrong ticker. GIS is General Mills. Interesting to see such a strong chart in the defensive sector. Finally, chart number 3 is Amazon. I mentioned a lot of the FANG stocks, Microsoft, Alphabet, Meta, Apple, Amazon, all reporting over the next couple of days. There's going to be a lot of news flow and a lot of movement. This is a great week to follow the charts, focus on key lines in the sand. For Amazon, my line in the sand is 125. That was this beautiful shooting star pattern in the beginning of June, sort of confirming resistance at 125. We traded up to that same level end of last week and now pulling back. Can Amazon regain $125? Folks, that's a wrap for the show. And thank you so much for joining us. here on a Monday afternoon. As a reminder, all of our previous discussions, interviews, and episodes are all at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night, and we'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.